Welcome to the Norris Group's 13th annual I Survived Real Estate Gala. The Norris Group would like to thank the following platinum partners: Norada Real Estate Investments, San Diego Creative Investors Association, the Outspoken investor Tony Alvarez, Wilson Investment Properties, Think Realty Magazine, and Realty 411. We'd also like to thank our gold sponsors, Seven Figure Flipping, Inland Valley Association of Realtors, Keller Williams Corona, Keystone CPA Inc., Brisas Escrow, Leivas Tax Wealth Management, In a Day Development, NorCal REIA, NSD REI, Pasadena Phoebe, Real Wealth Network, SoCal Cash Flow, Spinnaker Loans, and UDirect IRA.
All right, Terry, welcome to the party. You are filling in for Bill Allen. Terry Berger is with the Seven Figure Flipping. Congratulations on a very good Flip Hacking Live. It was very fun. You guys did a great job virtually, and it was very fascinating from an event planner to watch. You guys did a great job.
Oh, thanks, Aaron. Appreciate it. I'm glad you were an honor that you were there. I'm Bill Allen. Or I'm not Bill Allen. I'm substituting here for Bill Allen. He asked me to fill in for him. He's much better looking than I am. So honored to be here with such an incredible panel. We represent about 300 members that we teach them how to flip houses and that sort of thing. So what I wanted to kind of talk about today, and Bill asked me to talk about, is kind of the boots on the ground. Like, what are house flippers thinking right now? And so we pulled our membership, and I just kind of wanted to give you some thoughts, and if you're in that space right now, maybe some tips and tricks to kind of help you be a little bit more successful in there. What we're seeing, feedback from our members we're seeing construction prices and delays. Some members have paused building new construction. You know, some house flippers are out there being investors in spec builds and such. And with the rise of prices on lumber, they kind of paused that. Some have, some haven't. I'm currently building new construction right now because we got a great deal on a lot, you know, so there's some give and take there. There's lots of delays on tile, cabinets, doors, windows, things, you know, that get manufactured at a factory that due to COVID, if some of that stuff comes from China, you know, there's a little bit more of a lockdown. We've had to wait on stoves and things of that nature for weeks. And of course, as a flipper, right, you've got this hot potato going on where the longer the delay, obviously, the more interest carry you have to your investors. We're finding that contractors during this time are in incredibly high demand, and I'm sure that's no surprise to anyone. And so we're trying to figure out how to teach our folks how to systemize and get really granular and be ready to rock and roll on their properties day one, materials in, ordered, and everything. There are going to be delays, so we're just trying to help people avoid some of those delays. From a lending and appraisal perspective, we're seeing some really interesting things. So loans, if you've tried to refinance your house or buy a house lately, normally it would take you 21 to 30 days, 21 on the fast side and 30 days on the longer side. And those have been pushed to 45 to 60 days now. And you'll have multiple delays in that process. So I know for my company, we've had, I would say 50% of the projects have been delayed. So we kind of instituted this thing where if the lender goes past 45 days, that buyer pays us our interest carry for those days that we're delayed. And that's kind of how we've leveraged that. Appraisers are having a weird time, right? Because a lot of the properties are going above asking because of the shortage. And most of the markets that I study, there's 2 months or less of inventory. I know in my home market of Atlanta, in my county, there's 1.7 months of inventory for all price ranges. And depending how granular you get in the price range, it actually goes below a month. And so because of that, the appraisers are coming out and they really just don't know how to react to what I call the coastal phenomenon, right? Because, you know, when you're in an interior market and you're back, I don't know, 2004, 5, 6, 7, you're hearing how San Diego, you get 15 offers on a house and it goes above asking. We never really saw that in the interior markets until this housing market. And we're seeing lots and lots of that. So the pros though, right? There's a lot of negatives that I put in there, but the pro is that houses for house flippers, they're selling for more than asking. So when we run our numbers for, the little formula that we try to run, everybody who runs that number, then they figure out what margin they need. And they're typically getting a higher margin, which makes up for those delays and the extra interest carry and the extra loan delays and things of that nature. But for how long, right? We're also finding that buying good deals, while they are out there, they are really left to the very skilled negotiators to try to get those, because sellers think their house is worth gold because they're watching the news and they're listening. Some flippers in our group are selling. They market their properties before they're finished. Some don't like to do that, but some do. And they're actually getting them sold and working with the buyer to pick paint colors and do those sort of things, a lot like new construction. We do feel like because of the inventory shortage, and I really believe that inventory shortage was started 10 years ago in the last recession, that we don't have to go ahead and put brand new kitchens in anymore, because the housing market is so strong and hot right now, and cabinets are delayed. Maybe you can go in and work with the cabinets that are there. You give them a quick coat of paint, make them look really nice, and you don't have to go in and make it look like HGTV as much as you used to. What we're focused on really is just trying to become exceptionally well organized to win. I think our group is concerned about being caught with inventory. I know I suffer from that as well. Like I know that the banks are in charge, the Fed's in charge, these low rates, and I hope they stay low. But we can't continue to buy predicting elevated prices 6 months from now or 4 months from now. We're still trying to stay very, very conservative. I tell my team all the time, I want to be here thriving after the next correction, whenever that is. The general sentiment in our group is to avoid high-end properties and focus on the sweet spot of these markets. And I believe, personally, this is a personal thing for me, I believe the millennial monster is going to come out and save us in 2021. I used to tell, I train agents, and I used to tell agents all the time, when Jay Leno, y'all remember Jay Leno? Jay Leno used to do this thing called Word on the Street, and he would go out and he would interview people, and he asked them who the president was and who the Speaker of the House was, right? And we would make fun of these millennials, right, that didn't know the answer to those questions. Those are my customers. Those are the customers I want, because what I found in the last recession was people that had a nest egg to protect. That's when they go in protection mode, hibernation mode, right? But the people who really don't know about the political game and all of those sorts of things, those are the people that are out buying. Those are the people that took advantage of the first-time homebuyer tax credits, for example, that were offered back in the last recession. So that's what I'm seeing. I do agree with Marco. There was something here, the shadow demand. I did a lot of research on millennials in the last week and a half, and it is interesting. One, National Association of Realtors put out a study. 1 out of 2 transactions was a millennial. That's a 19-year-old, I guess, to a 39-year-old right now. And so I really feel like those numbers are boosting. Those older millennials, they got the shaft back in the last recession, right? Because they couldn't find jobs. The joke was they all moved into their parents' basement, and they get a bad rap for that. But honestly, those are the folks who went back to grad school, got an extra degree, did something different until they could thrive out of that last recession. And now those people are thriving, and they're out looking for real estate. And so I really feel like they're going to help push us into 2021 and have it continue to be successful. And it's interesting. I ran a number last week that says if you took a $400,000 house at a 3.25% interest rate amortized over 30 years, and you put 5% down, your payment's somewhere around $1,650 to $1,675, something like that. And if you bought a house 20% cheaper at 320, but the rate was 5.5, your payment was actually more. And so I think you're right. It's, Marco, they buy on the payment sometimes. I know that their income is dependent on housing prices and that sort of thing. However, it is really interesting to see what these rates are doing. So that's what I've got for you today, Aaron and Bruce.
Oh, great. I have some questions, and Dad does too.
Yeah, I think what's interesting when you say people buy the payment, one thing about owning a house is your payment's fixed and your rent isn't. And that's a very big financial difference going out forward. Go out 5 years, all of a sudden you've got somebody that's got an equity position put that house in Florida, have the house go up 5 or 10% a year, and all of a sudden you're an entrepreneur with equity. You get an equity line, and all of a sudden you start playing the game. And that's the big difference about trying to get, and you've already, what's interesting, we said, we had an $8,000 tax credit. What's really interesting about the human species this is in Moreno Valley, a house, very specific house that I bought. It sold for $365 in 2005. And it sold in 2009 for 64 grand. I was the buyer at 64 grand. And at that time, they had to offer an $8,000 tax credit for somebody to take it at an 80% discount. That's an astonishing, because you couldn't get a buyer because it was emotionally a difficult market. So, we have this big glut of young adults that are going to be asked to pay for a very big tax burden. I hope a lot more of them have a fixed house cost that starts with a 2% mortgage rate. To me, that would be very smart for America to do.
And I like what you said about the no down payment. And if you add an assumable option to those mortgages, I mean, it would be a beautiful thing, right?
Well, yeah, see, I was going to ask you, what do you think causes the next downturn, if you will, with your experience? Do you see one coming?
I don't necessarily see one coming, but I do think that the banks and the Fed are definitely in charge. And if for some reason, I tell people all the time, COVID-19 may not be our only problem ever, right? What would happen if some other event came in and hit us and we weren't expecting it? So I don't know what that looks like. I can only imagine certain things, but I think that the market will stay strong. I think that the politicians are going to continue to help the housing market along. I'm not worried about this eviction crisis that you see on a lot of YouTube channels and stuff like that. I honestly think the eviction crisis would help the housing market. I honestly think the housing market actually is in crisis because of the low supply, right?
Oh, it would help employment if you could have a builder build another $500,000 units. That would work pretty well.
Oh, absolutely. Yeah.
You brought up a really interesting, you said something interesting about the sweet spot. And in the California Association of Realtors, they do a study every so often. And this last time they did a good job segmenting by generation. And what surprised me is that millennials came into the market. The median price that they were buying at was $400,000, but so was the boomers. So by waiting and postponing what they were buying, what is your sweet spot? Because is it higher than you expected, the dollar amount?
I think it is now because I've been in real estate for so long. And, when you be in real estate for so long, you look at a house that was $200,000 10 years ago and it's $400,000 today. You're just like, wait, what? How did that happen? Right. But I don't believe they're going after the same product though, Aaron. The boomers want master on mains and they don't necessarily want a yard and that sort of thing, where the millennial generation are starting to raise families and have kids. They want grass. They want a place for little Johnny to kick a soccer ball in the backyard. So I think the product is different. And here in my market of Atlanta, there's a lot of 55 plus communities being built. And I don't see them fighting over properties here unless they're a ranch. If they're a ranch, they fight over them.
All right. iBuyers, is your group worried at iBuyers at all?
So
the We Buy Easy Houses group?
Yeah. So Zillow offers Open Door. Those are big players in the major metro markets. It's caused my company personally to only focus on new construction in Atlanta. So we're trying to find value add lots, things that we can do and build new construction. And then our secondary market of Greenville, South Carolina, there we are flipping and we don't have the iBuyer competition in those markets.
What's interesting, I've been following the data for years, and the rehabs they're doing here in California are hilarious. You're lucky if you get paint and carpet. And now that the IPO for Open Door has come out, they've basically admitted they're losing money on every deal. But you look at their rehabs, they're painting 1970s cabinets, and you're lucky if you get the brushed poles. It looks terrible.
It does look terrible. Yeah, but they have no margin to work with, right? And yeah, it's amazing to analyze their data.
But I do have investors that are flipping to them. So I know a lot of your group focuses on the wholesaling. And so taking down the problem children with people problems or property problems, dejunking them and flipping them to iBuyers is a way to work together.
It is. Absolutely.
One other question. Your group, are you seeing more pressure from real estate investors wanting to expand into other markets out of their home state?
I have been in that group for 5 years, and I have studied and asked and looked at everybody in the group. The smaller mid-level markets do great. That's where you can really go in as a small business owner and be the Zillow offers or be the open door, as opposed to trying to make that happen in a large metro. What I find is people in the large metro areas are trying to find secondary markets where they can have better margins, or have a lower entry price. For example, like in my area of Atlanta here, it's very unusual for me to be in it, a $200,000 purchase that needs fixed up, right? But I can go to another market such as Greenville, South Carolina, or Memphis, or Huntsville, Alabama, and I can find something for 70. But put 50 in it and have similar margins.
5-figure houses. It just feels like so long ago. We
Crazy.
visited there for a while, just not anymore in California, at a zero. Well, thank you, Terry, and thank you for filling in such last minute. And it's great to have that perspective. You guys your members are all over the country and do a lot of houses, a lot of flipping, a lot of wholesaling. So please hang on, and I'm sure we'll have some questions for you. Tom, we're going to bring you on. I was hoping to bring you on because you do some fundraising on very different asset classes, commercial, industrial. You're sort of all over. And to get some insights into how people are feeling as you're raising money, if people are scared, pools. I don't know if you can say much about even opportunity zones.
No, we've avoided opportunity zones for the most part because these are largely development and longer term, and most of our investors want to have a shorter term, lower risk, more stabilized situation. So we've kind of purposely not targeted that, although I know it's worked well for some people.
Okay.
Do you want me to give a presentation at this point?
Sure, go for it. Grab the screen. It's all yours.
See if I can figure out how to do this.
Uh-oh. That sounds like me.
There you go.
Let's see. Is this working? Are we on?
Yep, you're
Perfect,
good to go.
yeah.
Okay. All right. So my staff is left here. And they said, oh, you can do it, Tom. You can do it. First of all, thanks so much for having me on and with such other honored guests. And I've been, I think, not 13, but I think I've been a sponsor for 12 years. And it's so wonderful. Congratulations in crossing the $1 million mark. What a wonderful event. Yes, it is, has become the great ball for real estate investors and the wonderful charity that, Aaron, you started in honor of your mom, and it will be, and Bruce and I and you have all kind of bonded a bit since I went through a similar process. So, so nice to be participating again.
Thank you.
Thank you.
Let's, and Aaron, how, what a wonderful full circle here with having the pleasure of having hosted your dad and Sean there many years ago to get introduced, and then introduced to Doug, and now you working with Sean. It's really wonderful to see that growth. So my company, Wilson Investment Properties, focused for many years on turnkey house business. It did very well. We did several hundred, not quite in the league of the top ones, but pretty good business. But we saw increased competition for houses, and I was starting to invest more in commercial. And when I say commercial, it of course includes multifam. The word commerce means you buy something for income, although many people think of commercial as non-multifam, but it's both. So that's why I kind of tend to say both of those. But we shifted over to that industry, and it's done very well. So we've done 23 syndications. We're currently managing a portfolio of about 330 million, something like that. And I must say, I feel very, very blessed that we're running pretty stable. And I think that's because of the conservative approach we took. We certainly had our problems at the beginning of pandemic, but we were able to negotiate with the tough tenants, and we'll talk a little bit more about that as we go along. but if we don't have a second big shutdown, I think we'll navigate through this okay. We're pretty evenly divided between the major asset classes of office and retail and industrial and multifamily. And we are in most markets, major markets across the Sun Belt. And we do some development in California, but for the most part, our clients, our investor base is looking for more stabilized, some value add, but wanting more of a solid, predictable investment. So I've been investing for Bruce, make you feel a little better, 5 decades now.
Yeah, I feel young. Thanks.
So now you don't have to feel quite so bad. I was talking to Doug Duncan recently, and by the way, he certainly professes that this was not a recession for which the pandemic was a tripwire, that this is a unique event on its own. And he predicted a few weeks ago, several weeks ago, a partial kind of a Nike swoosh with a lot of W's in it. And I think so far it looks like that's how it's turning out. So indeed, it is a black swan event all on its own for sure. You could argue what the last black swan event was. I'm thinking it was really kind of 9/11. A lot of the other things that we worry about haven't happened, but this one caught us by surprise. Maybe everybody except Bill Gates. We claim that he's the one that said you should do it. This is a very nice graph that my staff found, which is showing how the pre and post pandemic numbers have affected the property values in all of these different sectors. So I'll just point out, of course, many of them are not, would not be surprises that we've got, of course, malls, lodging we know about. Strip centers, ironically, is considered to be pretty low risk in the retail sector because it's service oriented and doesn't get Amazoned, right? Doesn't compete with the internet. You can't get your hair cut on the internet. You can't drink a beer or have, on the internet, all of those things. And lo and behold, here we have a surprise that tended to shut down service as opposed to, big box. So that was a bit of a surprise, but I think it's the retail strip malls that we have held in there pretty well. We've, most of those are back open again and coming back up in occupancy. Most of them have continued to pay. We had some drop in occupancy, but and financial occupancy, but not too badly. And no surprise to us, one of our favorite categories has been industrial, and indeed industrial actually went up during this period of time. We have several, whether in the manufacturing arena, and they're continuing to manufacture a lot. Let's see here. How do we get to the next? There we go. So this was just published by Emerging Trends last month, where they interviewed 1,400 and surveyed 1,600 people in all different sectors across the country. So that's something all of us as, I think, syndicators and turnkey operators and so forth in the investment business want to know. How interested are our investors in writing checks again? To what degree are they still scared? And to what degree are they tired of the low yields of money sitting under the mattress and ready to get it deployed again? So if, you'd pick kind of the neutral ones there at the bottom at blue, and the agree that they're confident in making long-term decisions, you get about 2/3, 3/4 of the population is kind of at least thinking about writing checks again, which I think is pretty important. Of course, whenever you get in tough economic times, the lenders are less optimistic, and they tighten their constraints on loans. And of course, in the construction and the development arena, we're seeing a couple projects that are now delayed because we're having difficulty finding lenders who are ready to do construction loans again, or their LTVs have dropped. We even have one lender that gave a quote to one of our buyers of one of our properties, and they asked for a debt service coverage ratio of 2.0 with a 50% LTV. So that's the worst I've ever heard. So of course, the office trends, a lot of talk about the impact of COVID on office. And I think that's a discussion that needs a lot more talk and rational thinking than the headlines. Just like the headlines, past few years, was it all retail was going to be scraped from the face of the earth. And of course, that hasn't happened. Here we are with office. It turns out, if you look at this graph, you can see the absorption has dropped down significantly over the past 4 quarters. It's been so that's a new trend, of which actually it hasn't gotten any worse during the actual pandemic. Here's office rents. So very interestingly, now the rents have continued. These are national numbers. The rents have had a pretty steady climb. You pretty much put a ruler through that line of continuing to go up, which I think would surprise some people. So my thought is, of course, you've got companies that say we're just going to have people stay at home, but I feel very strongly that humans like to be with humans, and you're now seeing more reports about the productivity and creativity has dropped. Yes, we'll probably wind up with some hybrid, but I wouldn't be surprised within 2 or 3 years if we've got office occupancies that are back up close to where they were. They may even require more space, because if they are concerned about the separation, then they need more space for the same number of employees. So we'll see how that pans out. We're actually seeing we've remained quite stabilized in our office products that we have. Aren't really having a serious problem. In fact, we've got 2 properties in which the occupancy has actually gone up during the pandemic. Now, of course, it's important which metros they're in. Are they in metros that have inward migration, where they're escaping from cities and so bigger cities and problem cities? Yes. So I'm going to talk for a moment about some counterintuitive paradigms. So I've already talked a bit about office. This is a property we have in North Miami. Well, we've certainly seen how there's a big migration down that way. This property has actually gone up in occupancy during the pandemic, and we're talking not just physical, but financial occupancy. Retail, again, as I mentioned, many people have felt in the recent years that all retail is going to be scraped. Well, out of the 900 malls in the country, it's still, I think, pretty good probability a third of those are going to disappear, but a good another third will do very well, maybe even improve as they're moved toward more entertainment and service and that sort of thing. I think the most important, maybe one of the most important things I've learned over my 5 decades of investing is how you cannot be very careful about broad brushing any conclusions, and that each deal, each submarket in any metro, each product stands on its own. And yes, it's easy to get data that's aerial view of a MSA or of a certain asset, general asset class, but every single deal is quite different. So out of our 19 properties that we're currently responsible for or managing, our most challenging one, which I'll show in a minute, was retail, and our best one is a retail. And here it is. This is the largest liquor store in the state of Kansas. Sales are up 60%. So single tenant, 18-year lease. Things are going just fine, thank you. So again, it's really, really dangerous to broad brush any conclusions about a general metro or asset class. So here's the one that's actually been the biggest challenge. So this is a large power center on Interstate 40, 87,000 cars going by a day. It has 4 anchors in it. And normally the national credit tenants, and it has a shadow strip beside it. It's a $23 million property. And so normally you will buy a property like this because it's got national credit tenants that we checked out that had were doing very well with their own internet component. They're actually expanding into more brick and mortar stores. Balance sheets are good. So you consider this to be normally the lowest risk kind of tenant you could get. National credit tenants as a classification are the worst tenants right now on the COVID because they're playing their 800-pound gorilla card and saying we can pay, but we're not. Go sue us. So we had 5 rounds of negotiations with a couple of these tenants who said they weren't going to pay for a year. We got them back to 50% payment for 3 months, and they're back paying again. But so again, paradigms that normally you can count on in a situation like this can be quite different. Loans, of course, are quite different. CMBS is just about shut down, commercial mortgage-backed securities, which is Wall Street money going for commercial. We have 5 or 6 of those. The attractiveness, they are generally the lowest debt service amount because they'll do 30-year AM and best yield. They are non-recourse, but they are bears to work with. They've got folks in Wall Street who are deploying money. Their investors are their clients. The borrower is a pain, and it's so they're very difficult. It's almost impossible to negotiate anything different with them. Local banks, a couple we've needed to talk to and get some help for a while. They're quite cooperative. Elder care market. Well, we all know that everybody moved their parents out of elder care, and that's why the highest death rates were and all that sort of thing, right? Does anybody think that's going to be long-term? I don't think after a year of being pent up with the parents and kids and this culture in this country, that I think once a little more time goes by, they're all going to be anxious to get back into a facility. So as a Class C facility, what they're going to be looking for that's the cheapest? Probably not if they can afford it. Probably Class A. This is an artist rendition of a assisted living facility, elder care in Berkeley, that we've just finished entitling the land, and we have it under contract to sell, and it's at a profitable price, and it's doing very well, thank you. So again, did we make adjustments to it to make it more COVID friendly? Yes. And so there are things that you can do to help mitigate whatever problems get thrown at you. You normally think residential is the simplest to deal with, right? Well, we got the eviction issues and what happens when they stop writing checks for the tenants, and how do you show a property since you since it's hard to have people go inside and they can only do it by virtual tours and so forth. So of our 3 multifam properties that we have, 2 large ones, we have about 1,500 doors, I guess, in those 3. And their occupancy dropped a little bit. Physical occupancy, very little. Financial occupancy, a little bit. But they're all running positive. They're all doing well. But it certainly has been a challenge. And it's certainly had to deal with some things that we didn't used to have to do. Frequently, I'm asked, to what single thing do you most attribute your company's success and your personal success? And I'd have to say by having outstanding partners, outstanding relationships. And, we follow Beth Clifford's advice, and we hire and partner more on character than competence, although you need to have both. Certainly this COVID has introduced some new questions for us, to things that we have to deal with. What's the economic occupancy, not just physical? We industrial properties have done very well. So what's a reasonable cap rate on exit? We have 3 under contract to sell right now, which are doing well. In office, who are the tenants? So our office buildings tend to have a number of tenants that have income, and tenants who are, and clients, customers who have income that are largely dependent upon a government subsidy. So our guess is that the government's probably not going to stop printing money. So I think they'll do okay. And again, retail discussed that about picking things that aren't internet competing with. Do I think the retail strip malls and service sectors, which normally was pretty low risk, going to come back and do okay? Yes, I certainly do. And we're already seeing that happen. Metro trends, I think, Mark, you talked about that a lot. Yes. So certainly we're seeing that we've got a lot of migration coming from some of the big centers like San Francisco, LA, and Texas, and New York, coming down to Florida and Texas. They're certainly the 2 highest ones. GDP, my father used to say, be careful, son, said figures don't lie, but liars figure. So did you all see the Wall Street Journal headline? What was it, a little over a week ago, that said GDP up 33%? I had a couple of people contact me. It's like, no, it can't be. And of course, it was annualized. It was how much recovery. And nobody talked about if investment drops by 50%, if it comes back by 50, you're not back to where you were, and so forth. But it does look quite encouraging. I would say that certainly this black swan event that happened certainly reinforced my values and the company's values about how we select where we're going to invest. Certainly you want, for good returns, you got to get low cap rates. You want metros that have high growth rates. That's why most of our properties are in the Sun Belt. You want places that have that aren't over-regulated, that have good business-friendly policies, and certainly we walk away from most things that are brought to us because we're looking for, when we model it and underwrite it, we're looking for a very conservative approach to it. I'd say I look for a high return risk ratio. So that's my slides I have. If you have any time or want to ask any questions, Aaron or Bruce, I'm of course glad to.
I don't have any. You answered what I was going to ask. So, Aaron, do you have any?
Come on, Aaron, ask me a tough question.
Aaron, you're muted.
Aaron, you're muted. Can I help you?
Busted. Aaron's busted.
Right back at me. Kathy is up next. I do have some questions. Maybe we'll ask one. Industrial.
Mm-hmm.
I'm a little worried about industrial. I look at these Amazon buildings, and they're only using about the first 15 feet up. And with robotics and advanced engineering and advanced logistics, I mean, are we still going to need to continue to build industrial if at some point these robotics are going to be able to go all 3 stories high? At what point is it more beneficial for us to go up in industrial instead of out?
Oh, you mean to add on to the building in height, or build higher?
Yeah, to be more efficient, because robotics allow us not to be sort of, their Kiva robots aren't going to be able to reach to 3 stories high, but we're getting to the point, and Amazon has really invested in a lot of very strange robotics. They've got that ostrich looking one that they've got now. It's pretty interesting. At what point do we have to be worried about that?
Well, I think it's has to do with dirt space, right? The reason California's prices are high is because the dirt's so expensive, right? So I think it, and you find, and it's not a neighborhood friendly kind of thing. So I think most industrial and distribution centers and all that, maybe minus the last mile, are built in areas that have cheaper dirt. So I think that probably reduces the pressure to go up. And these industrial buildings with high bays and cranes and all that are quite expensive. So when you start going up on that, it's not like just adding a second story to a residential house. The other thing I'll throw out there is that there's actually more space in industrial that's manufacturing than it is distribution. So there's way more manufacturing than people realize in the U.S. Going on. And of course, part of what has allowed that to expand again is the automation. So the automation now helps us compete with the cheaper places offshore. Now we've got a new reason to be a little concerned about our supply chain, not having control of it. So I think manufacturing is going to continue to grow, and that's a major sector of industrial. And in fact, most of what our company owns and manages is actually manufacturing. I mean, these are serious manufacturers where they put in the equipment and they build the building around it. And they're probably not going to move down the street next week.
You raise the rents and they're like, meh, it's too difficult to move. I see what you're doing. Okay. All right. Thanks, Tom. We'll come back with some more questions as well. But,
thank you for tuning in to I Survive Real Estate 2020. To watch the full video in its entirety or to learn more about speakers and sponsors, please go to isurviverealestate.com and be sure to tune in next week for more I Survive Real Estate 2020. Thank you.